Hello, hello. Hi, everyone. Can everyone please take a seat? We're going to get started. Thank you. And the panelists, you guys can just take a seat in the front row, please, and we'll call you up in a bit. All right. Can you all hear me okay? All right. So, good afternoon, everyone. Thank you so much for joining. I have first and foremost have to commend you all for making your way and navigating your way through the colossal COP28 venue. And traversing the tapestry of all the different types of events that are happening and making your way here. Really appreciate you being here with us. I think that one of the reasons why that we are here is because we recognize the incredible urgency and importance to address the financing gap for adaptation and resilience. The pace of change has been incredibly fast and relentless. I personally recently, my cousin who's lives in Pakistan and makes documentary films, was cut off from all communication for days. I couldn't reach her, and she was actually making a film about climate change, but was caught up in the floods that occurred there, which, as many of you may have heard, 23 million people were affected by those floods, and a third of our country was inundated by those floods. So each and every one of us is being impacted by climate change in one way or the other. A couple of years ago, one more story. A couple of years ago, I had to book a hotel room for my three kids in my own town where I live for my husband and my kids because of the heat waves that occurred in Vancouver, of all places, and nobody was prepared for that. So we are really unprepared for these impacts, and we need to get the finance to flow to really address this gap. So I think that another really important thing for us to really get our heads around is that this is a pivotal moment. While things are happening that are incredibly challenging, it's also a time for us to turn this into an opportunity for transformative change. It's time for us to really look at the opportunities that are there and focus less on understanding the risks. While this is very important, and I think we've spent a lot of time in the past talking and thinking about risks, we need to move from the understanding of risk to the understanding of the opportunity and what that opportunity can look like. So that's why I'm really excited to be here with you all today and introduce our first speaker, who's going to talk to us a bit about the AIIB's work in this space, Rodrigo Salvado, Director General of Operational Partnerships Department from AIIB. Thank you.
Thank you very much. And it's actually our couple of events that we have to compete with the boys, right? So we'll see who wins. Yesterday, I think that by the end they were giving up, actually. So thank you so much. This is great. And also because yesterday I have a panel here on blended finance and innovative finance, and I got a lot of like questions around adaptation. So now I'm going to actually listen to you to give me the answer for the next time they ask me about it. But as Ujala said, I am the operational director, director of operational partnership at the AIIB. And in AIB, this is very important for us. Adaptation is super important. I think, the main question we always get is whether adaptation is a good business, right? Whether we actually can monetize adaptation. And I think that if you actually think about infrastructure and adaptive infrastructure, that's pretty easy to understand, right? When you actually make resilient infrastructure, you actually saving money. You actually, making countries like that makes economic sense, and it's not something that you can actually, not to monetize. And I think that is an important thing in my mind in terms of like how we do it. We do resilient infrastructure. We do also prepare communities. We basically, that idea that adaptation is not a good business is actually wrong. The thing is also for right now, the point of adaptation is we need to make sure that we actually have innovative products that actually meet the needs of adaptation. in the AIB, right, we have like two things that actually come together. One is our clear commitment with climate. We have a 50% of our operations committed to climate change, right? And we actually surpassed that to have like more than 55% of those things in climate. The other thing that we have is actually private sector. So we have like a 50% of our operations in private sector operations, and we want to do that by 2025. And we also actually surpassed that marker in 2022, and we are on the pathway to do it in 2023 as well. So this is actually when our two things come together. So climate on one side and also private sector on the other. The other thing that we have, obviously, in AIB is like we are fully aligned to the Paris Agreement, right? As of July 2023, we are fully aligned to Paris Agreement. And then, one of the things that also we said is like, well, you know what? We want to do actually innovative financing. And one of the places that we're starting to do that is on bonds, right? Bonds, not only for adaptation, bonds for resilience. And we actually very happy that in 2023, we issued the first adaptation bond of 500 million, Australian dollars. And we do that. And that actually is going to be, all of that is going to be doing and invested in resilient and adaptation pipeline. But one of the issues that our bank actually tells me every time is, well, it's not that hard to actually raise the money. The problem is when you actually go to the market and you are going to be raising money with an adaptation bond, the market is going to be asking you where you're going to be investing. So one of the key things here is how you're going to generate the pipeline. So it's not just about going and raising the money, but actually how are we going to put together the project preparation, the project adaptation, what is going to be the mechanism that we are going to see to generate the pipeline for them investing in adaptation. I think that is extremely relevant. So I hope that, again, the conversation today, but also through COP28, we can actually have like that conversation. We have, for example, I still believe that we don't have the balance right in terms of adaptation and mitigation, right? So, for example, in our case, we have 20% of our investment in climate that are adaptation. And we really want to actually bring that up, right? We want to bring it to 50-50. And I think there's a lot of that the other NDVs also have to do the same thing. So all these discussions in my mind actually go to that place. We want to bring adaptation. We want to change the paradigm. We want to change the fact that actually adaptation is not good business. We want to actually put together the pipeline to make sure that adaptation actually is there and people know what they're investing on. And then we need to actually put our financial engineering to fit the purpose of adaptation projects. And I think all these three things need to come together if we want to do it. What I'm saying is, yesterday I was saying one thing about the blended finance and innovation. Unless we don't do this, what we are going to see is actually a greater divide between developed and developing countries, right, about this, about technologies and how we do this. What we don't want to happen is what happened with COVID-19 with the vaccines, with actually only the rich countries were able to get the vaccine first, right, because just where like they have the means to actually do it. We don't want that to be there. We don't want actually that low-income countries don't have the capacity and the means to actually react to climate change in the way that high-income countries have. So again, from the AIB, we are very proud and very, very happy that you have this discussion today. We are really committed to this agenda. Again, not just about, it's not just about project finance, it's about project preparation, it's actually innovation. We are very lean, clean, and green, as we want to say in AIB. So really looking forward for the discussion today to learn from you. And again, thank you so much all for coming, and hope also for you that you have very, very successful COP28, ahead. So thank you so much.
Great, thank you so much. And yeah, lots of solutions and opportunities to discuss those a bit more today. So I'd like to invite the panelists up to the stage, and then I'll introduce you all. Please take a seat. Thank you. So I'm going to introduce you a bit out of order, sorry about that, but I'll start with Steve Waygood. Steve is Chief Responsible Investment Officer at Aviva Investors, which he joined in 2006. Alongside Aviva Investors, Steve has also co-founded the Corporate Human Rights Benchmark, the World Benchmarking Alliance, and the UN Sustainable Stock Exchange Initiative. Steve has also advised the UK government, the European Commission, the Financial Stability Board, and the UN on the creation of sustainable capital markets. Next to Steve, we have Bertrand Milo from CDPQ. Bertrand is the head of sustainability at CDPQ, which is one of the largest institutional investors in Canada and one of the largest pension funds in the world, managing assets under management over $400 billion. He leads the sustainability team at CDPQ. Thank you so much for joining us. Next, we have Maya Henerkes, who is Director for Green Financial Systems at the Climate Strategy and Delivery Department of the European Bank for Reconstruction and Development, the EBRD. Maya is a sustainable finance expert and ESG expert with almost 20 years of experience. Next, let's meet Danielle Jupiter from the Seychelles Ministry of Fisheries and Blue Economy. Danielle manages the 3rd Southwest Indian Ocean Fisheries Governance and Shared Growth Project. Thankfully, there's a great acronym, which is SWIOFISH 3. SWIOFISH 3 is a long-term regional program of the World Bank that aims to increase the economic, social, and environmental benefits from sustainable fisheries. Danielle coordinates efforts with key stakeholders, including the World Bank and government ministries, towards sustainable and resilient ecosystems, marine ecosystems. And finally, we have Emma Howard-Boyd. Emma has had an extensive career in financial services at the forefront of the climate change, environmental, and sustainable finance agenda. She's currently chair of the Green Finance Institute, chair of the London Climate Resilience Review, and global ambassador of the Race to Resilience and Race to Zero. So thank you again so much for making time to speak with us today. So I'm going to turn right away to you, Steve, with my first question. You've been at the forefront of advocating for sustainable and responsible investment for some time. And in a broader context, how do you see the role, the evolving role of the finance sector and industry in addressing the global challenges, particularly with regard to climate adaptation and resilience? And just adding on a little bit more to that question, what are some key strategic shifts that we need to see or collaborative efforts that are necessary to really move the needle on adaptation and climate agenda?
Viola, thank you very much for the question and also for the invitation from you and Rodrigo to be here, and also Sean. It's through my love of all of your work that brings me here, particularly Sean. I don't know how you managed to do it. You're everywhere. But the Climate Bonds Institute, wonderful work. So what I want to do is just very briefly explore the business case from a large asset manager's perspective. We're a large asset manager for one of the world's biggest insurance companies, Aviva. Now, Aviva is systemically important. And as we saw 15 odd years ago with the Great Recession, financial institutions that are systemically exposed can cause society issues too. And it's important that we think about society and the role of finance more broadly. So let me give you a kind of the downside risk first, and then the upside opportunity second. As an insurer, the reason why resilience matters, the reason why adaptation is hugely important, is the current structure of markets is motivating a roughly 3-degree scenario by the end of the century. It's roughly 3 degrees. There are other measures. Some people would say the implied temperature change is 2.4. Some would say if you add up all the NDCs, you get to 2.9. But let's just say it's 3 degrees for the sake of argument. At 3 degrees, as we now know, the science tells us that the geopolitical risk will be huge because roughly 3/4 of the world's population won't be able to live where they do today because the midsummer air temperature will be hotter than the human body can cope with for 20 days of the year. Now, this is a reality that some people are living today already. It's enormously difficult to model that. Geopolitical risk isn't something I can put in an integrated assessment model and come out with a number. But we can just, in purely conceptual terms, the level of geopolitical risk, the migration that would ensue would be enormous. No central bank anywhere in the world, even those that have said to us, you need to do a model, a climate scenario to make sure that you're systemically strong. No central bank has asked us to model that or has numbers that show it. So this is, at the moment, we have the international financial architecture was never designed to deal with this challenge. The resilience of the economy isn't strong enough to deal with this problem. Why not? Because if you had to take out home insurance at the end of the century, you almost certainly couldn't afford it. Even if we can price the risk, the level of the cost of your home insurance would be greater than the majority of people can actually pay. So the pooling system falls down. So if insurance falls down as a business model, banking, which needs everything they lend money to be underwritten, that starts to creak. And then if banking as a business model itself is starting to creak, then obviously those of us that have invested in banks, which we do, about a quarter of our corporate bond debt is in banks, then that starts to unwind too. Now, I've painted you a very dystopian scenario for the end of the century, a scenario in which finance starts to unwind because the physical risk is so great. And I'm saying to you that the system itself is not resilient to that. So the resilience that we should be thinking about isn't just the resilience of an economy or an individual security, it's the resilience of the global system. And it is not resilient to where we are heading, business as usual. So from an existential perspective, that's why an insurance company is so concerned about this. It's not because I happen to care about climate change and my children's future, which I actually do. It's actually, I'm here because our shareholders need a business that continues to function indefinitely, and it won't as we continue. Flip that around, the upside of investing in the transition is enormous. It will be bigger than the Industrial Revolution was in real terms to us today. And the opportunities to invest, as Rodrigo was saying, in infrastructure that promotes the transition is huge. Now, as Rodrigo alluded to, the problem at the moment is actually capitalizing adaptation is difficult. It doesn't generate cash flows, so it can't be securitized very often. Now, how do we go about getting around that problem? Sovereign bonds, sovereign green bonds, municipal bonds too. We want to be putting our money to work in that space. We want bonds to be issued pari passu at the same rate as sovereigns would be issuing elsewhere. We want the capital to flow into resilience because then we get a double dividend. So we want to put our shareholder and our policyholder money to work in that space, but we need the green bonds to be issued by the sovereigns for that to be possible. And we need to know that there's resilience. And then the final point, the current structure of the whole of the Task Force for Climate-Related Financial Disclosure, which I've had the honor of serving on for 8 years, it's all about transition and physical risk in the corporate space, not actually directly in infrastructure, and certainly not in the sovereign space. So we need the next phase of, I think, disclosure and reporting and data needs to be at the level of the sovereign and at the level of the system. And then that's how we can understand where transition and physical risk really sits. And then you start to engineer the system. And obviously COP28 can invite all the international financial architecture regulators to start considering to produce a transition plan, just as the outcome document from the stock take today already asks the MDBs to consider what they can do at their best. We also need to ask the international financial architecture, where is their transition plan? We need to ask countries, where is their transition plan? And at the moment, I'm not seeing that in the stock take. I'm not seeing that in the cover text. And I think there is a huge missed opportunity at the moment from the outcome document. We need it to encourage financial regulators to look at these long-term risks. They're simply not. I hope that's my 5 minutes.
That was brilliant. Sorry, is this working? Can you all hear me? I don't know if this mic is working. Okay, I'll have to take this one back. Thank you. Is it working? Okay, perfect. Thank you. Thank you. Thanks so much, Steve. And that's really interesting what you said about the sovereign versus corporates. I think in terms of disclosure, I agree with that, and I hear that all the time. But in terms of seeing issuance, we've seen very limited issuance from the corporate sector that's focused on adaptation and resilience. And I want to turn to you, Bertrand, a little bit to talk about that. But I think that's a really interesting point, and I completely agree with the need to push for the sovereigns. Bertrand, so you work a lot with corporate sector and corporate clients to not only identify their risks and disclose their risks, but also to kind of encourage them to be more resilient because that's of importance to you. So I'd really like to understand, like, how does that sort of interaction work with the corporate sector, with your corporate clients? Are they planning for resilience, and what does CDPQ do to sort of push for that and encourage that?
Well, thank you, and thank you for having me here. So CDPQ, $400 billion, about 60 in infrastructure, 650 in real estate equity. And then there is also quite a bit in real estate and infrastructure debt. So a lot of exposure to physical risk, as you can imagine. What we're doing is, because our thesis is resilience is at the state level is good and governments need to get their act together, we all agree, but corporates have a role to play. Corporates need to make sure that they're resilient, and so what we're using tools internally to identify where there might be physical risks in the portfolio, and then we submit the results to the CEOs of the portfolio companies, say, Madam or Sir, you got a problem here, what are you going to do about it? And first, today, most of them are incredulous, saying, oh, I didn't know I had a problem. Okay, well, you do. And then they look into it, and then they actually, in a lot of cases, actually want to take action. That is very important because they understand, to them it will be a question of insurability, you alluded to. It's also a question of making sure that you can continue to operate or you don't have huge disruptions. And so it is important to them, and they are taking action. In certain cases, the action they can take themselves, do a few repairs, etc. And maybe this is why you're not seeing resilience issuance by corporates, because it's actually embedded in their CapEx and OpEx. But in a number of cases, the subject is actually broader than the company itself. And this is very, very important. Finance, you tend to look at, well, I'm buying a stock, so I look at those numbers that move on the terminal, and that's all of it. Well, in the case of resilience, you need to look way beyond the scope of the company itself. I'll give you an example. We have an investment in a port in a country, and we have identified that that port is going to be significantly affected by the rising of the sea and flooding, potentially. Funnily enough, don't ask me to explain it, but it's not true of all ports. This one is particularly affected. But it's not just the port. It's the road and rail infrastructure that leads to the port and a third of the city in question. And we don't own the road and rail infrastructure. It's owned by the state or the railway company. And so there you need to engage with the port company that we own, needs to engage with the local, municipal, federal, and sovereign government and have the conversation saying, well, we all have a problem here. What are we going to do about it? And hopefully, and thank you for raising the issue, come up with some plans to protect that city and deal with the issue. So that's the way we approach the system, is little building block by building block. It's very important to us, given the size of the portfolio and given the fact that we're starting to see question of insurability going forward. And also, we own a lot of illiquid assets, and so even though it's not necessarily a pressing problem in 2023, by the time we sell it 15 years from now, because we're pension plans, so we're thinking very long term, it will be a problem, and we might lose value then. So it's a problem now. The other thing, and I would come back to what you just said, we would invest in state-owned resilience plans in the form of PPPs. I mean, today we invest in providing hospitals for the national health system. We just build a hospital and maintain it. We provide social infrastructure, so justice, legal system buildings and all sorts of other things like that on a PPP basis and get a payment from the government. We could do that with a dike, we could do that with anything, but the one issue we have is that the projects are not defined. And so we're engaging, at least in Canada, we're now engaging with local governments, say, okay, there is a problem here, what are you going to do about it? Maybe the solution is sovereign financing and issue some bonds, or the solution is a PPP, but let's think about solutions. Thank you.
And thank you, and that's always so great to hear that if the projects are there are investors who are ready to invest. So I think it's the flow of the pipeline of projects that, as you pointed out, can be a major barrier. And I want to talk to you, Maya, a little bit about that, because I know the EBRD also advises many of its clients on how to raise finance, and you're also an anchor investor for many of these clients. So it would be really great to hear a bit more about how EBRD's role is in supporting more issuers to come to market and providing support also in developing these project pipelines and getting them helping them to access capital markets as well.
Yeah, sure. Thanks very much. I I think, I mean, obviously we have this double role in that we issue bonds ourselves as EBRD, but we also support many financial institutions, corporate clients, for themselves to issue their bonds. And I think in that second scenario, very often we need to use quite a broad paintbrush, because in some of the emerging markets that we operate, first, there needs to be a functioning capital market in the first place, right? That's a precondition so that we can even think about issuing green bonds. So sometimes that's where we start. Sometimes we just start really with very basic support to regulators, central banks, etc., capital market associations and stock exchanges, so that there is capital market activity in the country. Once that happens, we can work with individual firms or companies or financial institutions that want to issue a green bond. So we can support them design their green bond framework. We can advise them on, frameworks that we think are good. We can look at them. We can take a view whether we think the framework works. And if the framework works in a way that sort of matches our EBRD criteria, then we can obviously also come in as an investor, and that very often helps give the issuance a push in terms of offtake, but also sometimes in the markets it's a little bit seen, like with many of the other MDBs as well, of course, as a sort of a stamp of approval. So it brings in other investors that perhaps otherwise would be a little bit shy to go into these emerging markets. So I think that's a lot what we do, and I think it's important also to acknowledge that very often we learn first together with the client on the lending lines. So we have a long-standing experience in extending green credit lines to clients through financial institutions, or obviously also directly. And this is usually where they learn about green selection criteria, and which is where we also have adaptation targets, for example, for ourselves. So this is really where we work with the clients, for example, a financial institution, to say, okay, how do I find adaptation projects? How do I identify them? How do I make sure that they actually count as adaptation, and by what criteria? So often the journey that the clients go through is they first learn with us on a green line, and then they later, at a later stage, they mature and they build the internal capacity, and then they move on to actually considering issuing bonds. Now, have we seen issuance of resilience-targeted bonds? Not really much. I think, and I hope I'm citing this correctly, but I saw some study from you guys actually, where you looked at, I think, over 35,000 bond issuances, and we saw that specifically our sweet spot is the most tricky, namely in emerging markets, not sovereign issued, so private sector, and then of course the adaptation component. So this triangle is very, very tricky to crack. But yeah, we're working on it, and again, often we come in first with the lending, and then under a green bond, obviously we can try to squeeze in a bit of both, even though they're still heavily mitigation tilted, I would say.
No, absolutely. I remember that report because I was working on the data analysis behind that, and you're very, very right that out of the green bond market, a very small percentage is actually dedicated to adaptation and resilience. One of the reasons is just a lack of awareness that you can even use it for that, and another reason is a lack of definitions. But I think what's really exciting in that study was that we realized that people were doing it anyways, despite a very limited amount of guidance. And we have someone on the panel today, who I'm going to go to next, who is part of a really innovative, pioneering sort of effort to go to capital markets with an issuance. So we have Danielle, and Danielle, I wanted to really kind of ask you to speak more about the blue bond, which was the world's first blue bond that was issued by the government of Seychelles. And can you tell us more about what that process was like, what you learned from that, and what others can learn from that experience?
Okay, thank you, Ujala. Good afternoon, everyone. The blue bond, why did we do a blue bond, first of all? So the Seychelles is an ocean state, and the economy is dependent on the ocean. Fisheries is one of the main pillars of the economy. However, majority of our fish stocks are being subjected to overfishing. So Seychelles wanted to move away from an open access and to transition into sustainable fisheries. So the blue bond was supported by the World Bank, and the World Bank assisted Seychelles to find the three investors. So three investors, namely Calvert Impact Capital, Nuveen, and Prudential, were the investors for the blue bond. So we raised 15 million US dollars, and it was partially guaranteed by the World Bank, 5 million, and a concessional loan from GEF, Global Environment Facility. So the bond has a maturity of 10 years, and in terms of the interest rate, it's at 6.5%. And because we have this concessional loan with Jeff, this brings down the interest, and Seychelles is only paying 2.8% back to the investors, and the rest is being covered by the concessional loan. Seychelles will be paying back the 15 million to the investors the last 3 years of the 10 years. So in the 8th year, if Seychelles is able to pay back the first 5 million, then the partial guarantee from the World Bank rolls to the next year, and to the 9, to the 10, and if we don't use it, then it's good for Seychelles. So the blue bond is being used to capitalize the Blue Grants Fund. So we have $3 million allocated to the Seychelles Conservation and Climate Adaptation Trust, which was as a result of the debt swap Seychelles had before the blue bond. So this grant is given to the people of Seychelles, to NGOs, to parastatal organizations who have projects related to fisheries management, to climate change adaptation, to diversification in the blue economy, and to manage marine protected areas. And then the 12 million, this goes to a bank, the Development Bank of Seychelles. It's like a public bank, and this it's used to finance project related to fisheries, but not financing boat, but we want to move away from boats, from fishing more, but service to the fishery and diversification of the value chain. So we are supporting fish processing, laboratory services, marketing. So this is it in terms of the money of the blue bond, what we are using it for. So what we have achieved so far. So far, Seychelles have funded over 40 projects, Blue Grants Fund projects, in capacity building, in research, R&D, in market and value chain assessment. And we have also approved 2 loans under the Blue Investment Fund. And with the blue bond, we have seen the first co-management plan for sustainable fisheries. So it's called the Mahe Plateau Co-Management Plan. We are supporting the management of sustainable use MPAs, as well as we have mapped different investment opportunities in the blue economy. So one question maybe the audience would like to know, why did Seychelles go to private placement instead of public? Because it was a small volume amount, and because it was untested before, it was the first blue bond. So to reduce the risk for Seychelles and the investors, we decided for a private placement. And then the private placement brings us close to the investors. So we have quarterly meetings with the investors. We discuss our challenges and our achievements and how we move forward, especially for the Blue Investment Fund, because the Blue Investment Fund a businessman can apply for $3 million for a project. And this is a large sum of money that has been made available to the private sectors. And this has never been done before. So we had in the beginning where people were a bit reluctant to come, but we have changed the operations of the Blue Investment Fund. We have made, we have reduced the personal contribution. We have allowed joint ventures where they can partner with an investors from overseas to do a business in Seychelles. So this have attracted businessmen to come later on in the years. And then I will say that we have empowered the people of Seychelles because such fund has never been made available, especially in terms of research, climate adaptation projects. So it has been really an achievement for the people of Seychelles. Thank you.
Amazing. Thank you, Danielle, for sharing all that. I think the points that you've made about all the sort of knock-on effects of the blue bond are really important because it's not just about issuing a bond and accessing capital markets, but it's actually even broader than that. And there's so many different benefits that can arise out of using different types of innovative instruments to finance adaptation and resilience. So thank you for forging that path. And another point I think that really sticks out for me with what you just spoke about is sort of the demonstration effect of what the government of Seychelles has done. Because like you said, there's a lot of uncertainty, it hasn't been done before. So that effect that it has on other sovereigns and sub-sovereigns is really important and critical to get the sort of movement and critical mass that we need in this market. So yeah, really appreciate that. And thanks for sharing. So moving on to you, Emma. Speaking of forging paths, you've played a pivotal role in forging many different paths in advancing different initiatives in the UK, environmental and climate initiatives. I was hoping that you could highlight some success stories that you've seen over your time working in the UK with innovative financing mechanisms. Some success stories of different initiatives, different instruments that have been used to finance adaptation and resilience. And again, similarly to Danielle, if you could share any lessons that have been learned through that process and how others can kind of take that lesson and replicate and scale up.
Wonderful and great to be here. And I'm always reminded when I attend a COP how much of an immersive experience it is. And I think we're experiencing it right now in terms of where the adaptation agenda often is competing with something else. So trying to concentrate when there's another event taking part next door is something that the adaptation and resilience agenda, perhaps because of how it is named, is often dealing with. But it came to the fore in my role chairing the Environment Agency in the UK. The Environment Agency is an environmental regulator, but it's also a delivery body for flood. That increasingly we were seeing the impacts of climate change play out and putting our net zero mitigation investments at extreme risk if we continue to see them in a very, very different bucket. I think we've also suffered because it is often seen purely through the risk agenda, purely through the adding of costs agenda, rather than investing to save for the future and protecting our future assets. And I think if you look at the original framing of where adaptation sits in the Paris Agreement, we shouldn't be thinking of these things separately. And again, I think where nature and the nature positive agenda has helped is by shining a spotlight on the opportunities that exist. And what we've heard from Danielle, taking these risks on new forms of financial instruments can lead to multiple assets, which flow through really importantly to real things happening to real people. And I think that's what we've got to remember, that whilst we all are working on the financial agenda, this is about protecting lives and livelihoods. And the world that Steve painted as is already said, is a world that very many people are already living in. So it's in all of our interests to make sure that we're investing in a very different way and framing the adaptation agenda, perhaps through a climate security lens, and as a massive opportunity if we get this right. So delighted in the audience that we have Nicola Ranger, who led a paper, Mission Climate Ready, that a few of us wrote earlier in this year to frame this agenda through that positive lens. It is possible with the right enabling environment. Let's focus on getting that right enabling environment rather than say this is difficult. And again, Fiona Stewart from the World Bank, who is doing some really interesting thinking about how we perhaps derive flows into the adaptation and resilience agenda in a very different way, looking at how we might look at our pension funds, our sovereign funds, instead of through forex risks, foreign exchange risks. Can we do something like that to protect all of our investments? Because this is a whole world problem. And if we're only looking at assets, we're looking at this in a completely different way. I think also flowing through to the city lens, and this is where we see some really good and early thinking of different ways of forming financial instruments. Bringing in data can help us approach this in a very different way. I think we're all very keen to see what happens with California's resilience bond. If you go into the detail of the draft legislation, it sets out very clearly the different ways that that money, if raised, paid for by the citizens of California, will help at local community levels on all of the different perils. So framing this in the wildfires, the droughts, the sea level rise, the different forms of flooding that we are seeing play out right now. Lots of small projects taking place in the UK, joining up the dots. We need to scale those up massively and build on the whole technical and practical assistance to have these projects that could be invested in meet the levels of that are required for a large investor like the insurance pension funds to flow through to these much, much smaller projects. So across London, where you've got a growing risk of surface water flooding, can we pull together across the whole of London ways of packaging this up into a meaningful amount of money that large-scale investors can actually make these initiatives deliver real benefits? I think my final thing I want to say is, again, we need to take those risks, get on and do it, and recognize that this is happening now and something that we need to be doing now, not in the future. Thank you.
Thank you, Emma. I think two of the words that you said really stuck out. Well, everything you said was great, but your point about packaging and aggregation, I think, is a really critical one, because the scale is so small. The scale of the projects is often mismatched with the scale of the investments and the investors, what they're looking for. So I think that packaging is really important, aggregation is really important. And another thing that you mentioned was you use the word framing a lot. And I think we need to reframe a bit what we mean when we say adaptation and resilience, because it's been traditionally very narrowly viewed. Adaptation is hardening of a building or a flood wall, but actually adaptation and resilience touches every single part of our economic system, our daily lives. So we have to frame from the nature lens, from a people lens, and from an infrastructure lens, which is the more traditional way. And I think in that way we can have a more expanded sort of view of what resilience is and package it in investable instruments. So yeah, thank you. Thank you for sharing that. So we have a few more minutes left, and I'd like to do a quick sort of rapid fire with all the panelists. So I'm just going to ask one question, and then if we could maybe start with you, Emma, since you're already holding the mic, and work our way backwards. So my question is, what is one critical idea, innovation in your area of work, in your space, whether it's policy or practice, that can really help catalyze resilience finance for adaptation and resilience?
it's always difficult to just cite one example, but I think this is where you need to bring the real world regulators in lockstep with the economic regulators and the financial regulators. You need to get radical collaboration between those that are working in finance and those that are doing the infrastructure building, the civil engineers. I think those sorts of collaborations are taking place. The Green Finance Institute with an asset management organization, Impacts, is working with the Bank of England and the Financial Conduct Authority now to look at adaptation through a very, very different lens, and it is about bringing those mixes together. Thank you.
Okay, so one idea from Seychelles I will share is that large MPAs, if we protect our marine space like Seychelles have done, we have protect 30%, 15% no-take zone with high biodiversity. And then we have another 15% for sustainable use zone where we have allowable activities, so with special conditions, what are allowed and what are not allowed. So having large MPAs that protects carbon sinks, such as large seagrass meadows and all this, will help in terms of reducing the climate change impact. And then another thing is the Blue Investment Fund. It's a revolving fund that provides finance to the people of Seychelles and in diversification in the blue economy. So this is, in terms of financing, I found this is it's a good thing for other countries to replicate, because it's a public and private partnership. So thank you.
Yeah, I feel a little bit rebellious. I'm going to say two things. The first one is we really need to work a lot more with the FIs that we work with, the corporates, for them to understand first about climate risks. And we do that a lot now. You've mentioned it through transition planning. So we're engaging with all the FIs over time that we have client relationships with, for them to really deep wire climate risks into their own understanding and their own business, and then we're doing this through transition planning. And the second thing is, I think, by producing really easy to use tools, because in adaptation there's still a lot of judgment calls. I see lots of local FIs, especially in those emerging markets where really the impact of climate change is felt the most. They still find it really difficult to identify what counts, what doesn't. So anything that can help to simplify that, whether it's like a taxonomy or, you know, a black-white list to say yes, no, I think all these tools, they help tremendously.
I was going to say I completely agree with Emma and just go with what Emma said. But I'm now going to also add I completely agree with Maya. So I don't know if that's my one thing or if I can add my... So just to amplify it, so Emma said we need economic and financial and real economy regulators to work together. And Maya just said transition plans are hugely important as the key. That was your first of two. Imagine a world in which corporates and investors and regulators and countries were setting out transition plans that interacted with each other, that set out what they need to do by way of resilience, what do they need to do by way of transition, and that there was a body somewhere that helped guide that transition. Now, we haven't begun to think about how the real economy and the political system governs that transition. Transition plans have to be at the heart of it. Have to be at the heart of it. We're only just beginning to explore what a country or a regulator transition plan looks like. Corporates are even corporates are only 3 or 4 years old, aren't they? So we have to get on with it much faster. But transition plans, there we are. It's arguably thousands of things.
Thank you, all of you. I have nothing to add. But yes, I will say there needs to be a lot more thinking about how to help governments finance it, because financing it all on the public balance sheet the problem is too big. It's not going to work. So there needs to be thinking about structuring PPPs, using blended finance and other tools to finance this very challenging issue at all levels of government. And as much as we said, everybody needs to cooperate together within states, also municipality and sovereign governments, and if there are any provincial governments, they need to all work together. That's just within one state, it's a problem. So there needs to be cooperation all across the board.
Brilliant, thank you. I think this stopped working. No, it's still working. Good. Thank you so much. That was brilliant. And I think that a lot of the points that everyone made were building on each other's. And one point I'd like to make on the transition plans, I know that transition plans, currently when we speak about transition plans, we're often talking about transition to zero carbon, net zero. And there's an opportunity to really make sure those agendas are connected, a transition to a resilient future and a net zero future. So that's also, I think, bringing the adaptation and mitigation sort of conversation together is also a real critical challenge for us to attack moving forward. And hopefully this COP, I think, has a lot of focus on that as well. So thank you so much. We have a few more minutes, so I think I'd like, if you guys can stay for a couple more minutes, to open up for a quick question. Yes, please.
What role do you think that resilient clauses should be playing in debt, hurricane clauses, etc.? So building resilience into the debt instruments themselves. And then also the role of things like these sustainability-linked bonds, where you're actually starting to reward outcomes. So theoretically, it could be a transition plan. If a government issues a really ambitious transition plan, could you have bonds that actually pay out based on that, and then you actually start to reward that ambition? So those are two potential debt instruments.
Who would like to take that question? Bertrand.
Thank you. Yeah, why not? Transition-linked bonds, definitely. Let's define transition and let's make sure it's ambitious, because in sustainability-linked bonds, there's quite a question on that one. The other question you had was with regards to cat bonds, I guess, and ish. Yeah, that one is trickier. And I say to my colleagues internally, we're a pension plan, not a casino. And the problem is cat bonds is a bit casino-like. It's very difficult to put a probability on the event happening. And therefore, for us, not suitable, given that we like stability, etc. But I guess if you're more of a speculative kind of investor, then that would work. I think you need to know your markets.
Steve, do you want to add?
I do. Fiona, great question. By implication, you think they're important, and I completely agree with you. I think they're hugely important. I'd like to think about the bond market, not just individual bonds. And when I think about the bond market and I think about responsible investors more generally, I think we as an industry have been woeful at engaging with the Debt Management Office on resilience clauses in the system more generally. And given that we're an insurer and we need economic resilience, we should be using our stewardship voice at the level of the sovereign, not just through the DMO, but more generally to encourage the transition, to encourage better resilience. And I believe, in terms of a prediction, I believe our industry, as it begins to wake up to the existential crisis that not transitioning represents, as an industry, we're going to get much better at doing that DMO engagement and that sovereign engagement. And a final point, I love the work that you did on sovereign disclosures as the World Bank Group about a year and a half ago, and I continue to raise it at the TCFD as the future. So I agree with your first few points.
Thanks.
If I may add, this very important what Steve just said, engaging with governments, and we're talking, we're on the Net Zero Asset Owner Alliance, and we're starting to talk about doing that. And the problem is, there is no scenario in which my CEO is going to talk to Janet Yellen saying, you guys need to price carbon in the US. That is not happening. But there needs to be, we collectively needs to think of a mechanism for this to happen. And not necessarily Janet Yellen, because maybe she doesn't know anything about climate and everything, but the US government in general. I'm not picking on Janet. Maybe she does. Really she really gets it. I don't know. It's just an example. But governments tend to be quite siloed, but I think it's really, really important going forwards that there is a mechanism for investors in sovereign bonds, when they have something to say to the government, to be able to say it. Right now, there is not. There is no investor relations sort of page on the website, and there needs to be.
Very interesting point. Thank you. I think we have time for one more question. Anyone? Yes, Nicola.
Hi, I'm Nicola Ranger from University of Oxford. So I wanted to come back to the comment that was made early on in that adaptation doesn't bring returns. And I wanted to ask what specific types of adaptation are being referred to there? Because certainly from the analysis that we've done that looks at a whole economy level and sort of maps out all of the different types of adaptation, yes, there are some, a flood defense, for example, that are very difficult to derive a commercial return, but actually there are many, many, many that actually do deliver quite substantial, returns. So I was just wondering what evidence was being drawn on there, and if there are particular types of investments that were being considered there.
Thank you for asking that question, because I wanted to ask it too. Steve.
So it was a point I made, and you may tear this answer up because we may have different definitions of what we mean by resilience bonds, perhaps, or resilience. But what I mean, of course, a country investing in its own resilience is hugely important economically. Of course it is. And I've seen various studies that talk about a 1 to 10 return. So at the level of the sovereign, it makes great sense. But if you look at it through an asset management lens, we're looking for investments that generate cash flows. And they don't all do that. The resilience cash flows, if I'm investing in a mangrove, how is that generating cash flows? So whilst it's a good thing, and maybe this is the flood defense point, whilst it's a good thing to be investing in resilience, it doesn't generate the cash flows that I think that we need. The sovereign should be making the investment, and we can capitalize the sovereign debt, and we're super keen to do that. But if perhaps you want to come back, and I'd love to hear about what are the actual securitized assets that are resilience. The question back to the questioner.
Mic back to Nicola. I think she wants to just respond really quickly, and then we'll wrap up.
Oh, so I'll respond quickly, and maybe something for a longer discussion.
Please.
Well, I think, for example, see infrastructure being a key one. So certainly if you look at adaptation across an economy, some things are an adaptation investment, like a mangrove or a flood defense. But actually a lot of it is just about doing any other type of asset, but doing it in a more resilient way. So agricultural systems, infrastructure. But actually, if you look across an economy, those are actually the really critical adaptations we need, which are fully private sector adaptations.
So I think the point you're making, which I would completely agree with, is that everything that we invest in should be resilient, and everything should have a resilience plan, and that comes back to the being resilience clauses in the issuance. So I was talking about resilience as an asset class. It is really hard to capitalize, but everything that we own should be resilient, and actually isn't. And it's really hard to get data on where the physical risk exists. We've got it more from countries now, companies, because of TCFD, but in our real asset portfolios, in our infrastructure portfolios, it's really, and in our sovereign portfolios, it's really hard to pinpoint where is the resilience risk or the physical risk exposure. All of it should be, most of it isn't.
So I think that's a really good point, pointing out the lack of data and information to be able to pinpoint, and also in terms of making our existing assets resilient, there's that element. And then there's this element of an enabling the entire system to be resilient, going back to your point about ports. So for example, if you invest in an asset which is a port, everything around that port also needs to be resilient, the roads. So we have to find ways to have really systemic plans that are then financed through different innovative instruments. It's not always going to be a bond. It's not always going to, we have to have a mix of different financial solutions to solve this challenge. We need everything, basically. But I think with that, we're going to wrap up. But thank you all so much for being here. This was a really great discussion, and I hope that it inspires you with the next events that you're going to and the rest of COP. And yeah, have a great rest of your day and the rest of COP. All right.